Bismillahirrahmanirrahim. Assalamualaikum and hi everyone. My name is Fitri and today me with my group that consists of Axel, Olier, Resa, Anak franchise and Shonna, Anak franchise will present to you a various of topics in this session. In this session, we are going to learn about credit derivatives, credit swaps, credit options, credit link notes and contract for difference. So, I'll be starting our presentation with the fundamentals of credit derivatives. Think of this as specialized financial tools designed to strategically move credit risk from one party to another. Historically, banks use loan syndication of securitization to manage their risk. But those methods were public and often damage client relationships because they signal a lack of trust in the borrower. Credit derivatives solve this by being private, over-the-counter OTC contracts that can be customized for specific needs. Okay, the key concept to grasp here in the credit risk premium. This is essentially the extra return a market demands for taking on risks, calculated as the bond yield minus the risk-free rate. When you see this premium spike during a recession or a company scandal, is a clear signal that the probability of default has increased. That's exactly what these derivatives are built to hedge. Now, let's move into the most common strategy, which is credit swaps. As the name suggests, these are based on the logic of exchange. Instead of selling the physical asset, parties simply swap the risk associated with it. We are going to focus on three specific types found in our market: the default swap, loan portfolio swap, and the total return swap. The first one and most famous one is the credit default swap, or CDS. Okay. Think of this as financial insurance. It's a bilateral contract where the protection buyer pays a regular premium to the protection seller. Okay. The seller only pays out a contingent payment if a credit event occurs, such as bankruptcy, a failure to pay, or significant rating downgrade. The beauty of the CDS is that it provides synthetic exposure. You get the protection of an insurance policy without having to actually transfer or sell the underlying asset. Next, we have loan portfolio swaps. In this diagram, you see public bank and agro bank on the sides with a merchant bank in the middle because these are OTC products. Okay. The merchant bank act as a arrange to structure the deal. The main purpose here is to reduce concentration risk. If a bank is too heavily invested in one sector, they can swap that risk with another bank. It's a powerful way to diversify exposure without having to issue new loans or lose existing clients. Okay, the next one is the total return swaps, TRS. This is unique because it's not just about default, it's about total economic performance of the asset. In this setup, one party swaps the total return, meaning in the coupons plus any capital gains or loss for a floating interest rate. It's an incredibly cost-effective way to gain exposure to an asset's performance without the capital burden of owning it on your balance sheet. And that concludes my part of fundamentals and swaps. I will now pass it over to my teammate to explain credit options.
Hello, my name is Shonna Jite, and today I'll be talking about credit options. So what is credit option? So a credit option is a type of derivative contract where the underlying value is tied to the credit worthiness or the credit spread of a specific reference entity, such as a bond or a corporation. These financial instruments serve as vital tools for investors looking to manage credit risk or exposure and speculate on the movement of credit spreads or enhance yield through structured strategies. By using these options, market participants can effectively hedge against the likelihood of a borrower defaulting or take speculative positions based on anticipated changes in credit risk. Moving on, over here we have several distinct types of credit options, each catering to different investor outlooks and protection needs. A credit spread call options pays off when credit spreads widen, indicating a bearish view as credit quality deteriorates, while a credit spread put options pays off when spread narrows, reflecting a bullish stance on improving credit quality. Additionally, digital credit options provide a fixed amount upon the occurrence of a specific credit event for default protection, and credit default swaptions offer the right to enter a credit default swap CDS at a future date, allowing investors to time their credit protection. So, last but not least is the payoff of a credit option. Specifically, a credit spread call option is determined by whether the market credit spread exceeds the established strike price. When the market spread is higher than the strike price, the option is considered in the money, and the buyer receives a payment to compensate for the loss in the underlying bond value. And that is all for the credit option. Right over here, we have credit-linked notes, which is a debt instrument where the repayment of both principal and interest is contingent upon the credit performance of a designated reference entity. Under normal circumstances, where no credit event occurs, the investor is entitled to receive their full principal plus interest. However, if a credit event such as a default takes place, the repayment to the investor is reduced accordingly, shifting the credit risk from the issuer to the note holder. So right over here, we can see the structure of a credit-linked notes involves several key parties with specific role. The issuer, often a bank or special purpose vehicle, who structures the note. The investor, note holder, who purchases the CLN and assume the credit risk. And the reference entity, which is the company or borrower whose risk is being transferred. In this arrangement, the issuer also acts as the protection buyer, effectively transferring the credit risk of the reference entity to the investor in exchange for the funding and risk assumption provided by the note. As we can see, the mechanism of a CLN functions differently based on the credit health of the reference asset throughout the life of the note. In a normal scenario without default, the investor benefits from periodic coupon payments and the return of their full principal at maturity. Conversely, if a credit event or default occurs, the investor suffers a financial loss as the repayment is reduced based on the recovery rate of the reference asset. As we all know, investing in credit instruments offer a balance of potential rewards and significant risk. The primary advantages include higher yields compared to traditional bonds, opportunities for diversifying credit exposure, and providing a useful tool for risk transfer. However, these benefits are countered by risks, such as direct exposure to the credit event of the reference entity, the inherent difficulty in valuing complex structures, and limited liquidity within secondary markets. And that is all from me. Thank you.
A very good day, everyone, and my name is Axel Resa, and today we are looking at contracts for different, or we call as CFDs. Put simply, a CFD is a derivative product that allows you to trade on the price movement of an asset like Apple stock or gold without ever actually owning the underlying asset. You are entering a contract with a broker to exchange the difference in price from when you open the trade to when you close it. It is pure speculation on price action. Next, the real power of CFD lies in two areas: direction and leverage. First, unlike traditional investing, you can profit regardless of the economy. If you think the market will rise, you go long, and if you think it will crash, you go short to profit from the drop. Second, CFDs are leveraged. This means that you might only need 1,000 ringgit to control 10,000 ringgit worth of shares. While this maximizes your capital efficiency, remember, it amplifies your potential profits, but it also amplifies your losses. However, trading CFDs is not free, or is it risk-free? You need to be aware of the spread, the cost to enter the trade, and overnight swaps, which are interest fees if you hold positions for days. Because leverage is risky. Using risk management tools is mandatory. You must set a stop loss to automatically cut your losses if the market moves against your expectation. So, never trade without a shield. In conclusion, CFDs are powerful tools to short-term speculation and hedging. They offer high reward potential through leverage but comes with high risk. They are not for buy and hold investing, but it is for active trading. So, that's all from our group. Thanks for watching.